Oh man, nobody thought we were gonna revisit all-time lows with inflation going down. But woo, that's exactly what's happening. And in this video, we're gonna talk about why. Why are we reaching all new time lows again? Maybe it's because countries like the United Kingdom are threatening, how dare I say, to slash tax rates by the most since the 1970s at a time when the country is about to enter a recession. No, it's actually probably more likely a Goldman Sachs report that we're about to go through that is a little bit scary. Sure, look, a couple days ago we had the Federal Reserve come out and tell us stuff that we already knew, including a 75 basis point hike coming. But really what happened is the Fed told us they are impatient in getting inflation down. I went through my notes again and I was absolutely flabbergasted when I looked at my notes again and I realized, oh my gosh, here we go. The Fed is redefining what they defined in the past yet again in another way. Now, we've talked about the Fed redefining their goal from inflation to getting job openings down and quits down. But another thing that they redefined is the lag of monetary policy. So let's start there. Number one, the Fed has historically been known to tighten monetary policy, and that's supposed to tighten conditions in markets and spending and, essentially at businesses and with consumers about 18 months later. So you've got about that 18-month lag. Well, a few months ago, in June, Jerome Powell told us that this lag is probably more realistically just a 6-month lag. Well, 2 days ago in the last Fed meeting, Jerome Powell redefined this and said, well, actually, we think financial conditions are actually affected immediately. And sure, maybe there's some lag, but we actually think financial conditions move before we even act. So maybe that lag is closer to zero than we ever thought. So for the first piece, if you're wondering, for the first reason today, why is the market falling more? It's because we finally realize that, oh my gosh, well, first of all, the Fed put on their big boy pants and they told us the truth that we need to get interest rates way higher than the market thought. That is 4.6% or higher as a terminal rate for the Fed funds rate. We got to stop paying attention to just the inflation number, but we got to make sure that the job openings numbers fall, and I'm going to provide some catalysts in this video as well. And we've got to make sure that the quit ratio falls. We'll talk more about that in a little bit. But we also got from the Fed, and it's just another U-turn to the dark side, that, we kind of think our stuff, affects everyone right away. So screw this lag talk. We're just going to go aggressive until rates go down, or inflation rates go down. And that kind of aggressiveness is exactly what's leading to the number 2 concern today. So not only more digestion of what's going on with the Fed, and dare I say indigestion, but also this Goldman Sachs report. So I actually have the actual Goldman Sachs report. And Goldman Sachs is coming out suggesting that because interest rates and the interest rate path is now expected to be higher for longer, equity valuations have to come down, potentially to a 6 and 12-month forecast for the S&P 500 of 3,600. 3,600, folks, but it could go even lower in the short term. And I'm going to show you what that low number is in just a moment. But look at what 3,600 is. This is the S&P 500. You could find this on Webull by typing in SPX. In case you're wondering, you don't have to use SPY or the other ones. You just type in SPX. By the way, if you like Webull, they're giving away up to 12 free stocks, which is nice during a time like this because we could all use an extra 12 free stocks. Just go to metkevin.com/Webull. That's WEBULL, and follow the steps to open an account. metkevin.com/Webull, get 12 free stocks. But take a look at this. We had our Fibonacci floor here right around June 17th. June 17th is approximately when we last hit a Bitcoin floor as well, and it's when real yields on the 10-year tips peaked. Now we'll talk about the 10-year tips next, but we are dangerously close to approaching that floor again. Right now, the S&P 500 is sitting around 3,700, and the last floor that we saw in June was 3,636. But you've got to be cautious because we're not really good about respecting floors. Back when the chart of the S&P 500 looked like this, or should I say the NASDAQ, because that was a little closer, we'll go ahead and use QQQ. We'll go to the day chart, and this is just a caution about floors. See this yellow line right here? Well, we thought this was a floor. That's because we bounced off of this floor Feb 24th, March 8th, March 14th, and then again around the end of April. Yeah, well, floors don't do you much good when they do the following. Okay, so quite painful in the market, and the S&P 500, according to Goldman Sachs, is expected not only to be at 3,600 6 and 12 months from now, which basically means zero growth for the next 12 months. Folks are thinking to themselves, as they should, thanks to rules like opportunity cost, which of course, and of course the psychology of money, which of course we talk a lot about in my Stocks and Psychs course linked down below. But if you get any of the programs, whether it's on Stocks and Psych or in real estate, you join me in the private live streams. Today we'll be talking about CATL in the private live stream and actually going through the fundamentals and financial analysis and the statements of companies. So that way you don't have to do it, I do it for you. Just use the coupon code linked down below that expires at the end of the month. But take a look at the rest of this pain that we potentially have from Goldman Sachs. They suggest that in the near term, investors are going to focus on earnings and margins. This is particularly why I'm personally so exposed to Tesla, because I feel that as investors focus on profit margins, they're going to see a giant highlighter in Tesla as Tesla profit margins exceed expectations wildly, which is just my belief right now. And Wall Street realizes, oh my gosh, Tesla's actually doing quite darn well. But in that near term, we're expecting more inflation. Even though we're seeing temporary signs of some easing, we're still seeing those wage-sensitive sectors like shelter and food away from home really killing it. And that is going to lead to a potential trough of an S&P 500 of 3,150. That's right. If we actually have a classical recession, we could potentially see the S&P 500 go down as low as 3,150 according to Goldman Sachs. 3,150, just for comparison, to today's 3,700 level, represents an approximately an additional 15% decline of the S&P 500 from today's levels. That's scary. So not only, in case you're asking yourself, why is the market down today, not only do we continue to parse what the Federal Reserve is saying and realizing that, oh man, now we're going from talking about inflation to actually trying to get job openings down, getting quits down, but the Fed's basically under this impression that their poop makes everybody else stink immediately, even though most institutions believe that's not true, that there is indeed a lag, and this is leading the Fed to be overly aggressive with the market until, of course, they'll be forced to U-turn. Now, that U-turn might be a long way away. In fact, the market is really not pricing in that the Fed is going to U-turn until likely August to December of 2023. It's actually quite scary. But beyond that, we've got to talk some catalysts, because we do potentially have some hope on these dates, or it'll just be bad news for more. And boy, oh boy, talk about bad news for more when we look at treasury yields, and then we'll look at some of those catalysts. But treasury yields right now, an absolute complete disaster in terms of being a bond investor. But if you want to buy bonds today, they look pretty darn juicy. Take a look at some of the bonds as listed by CNBC right now. We're looking at a 10-year treasury at 3.7. If we just go 2-year treasury, CNBC, and we give this a quick little Google here, what do we end up with? 4.14. That's right, folks. Right now, you, for a very limited time only, can get yourself 4.14% on a 2-year treasury bond. You could even go down as low as a 6-month treasury and get yourself some gorgeous yields. And since Goldman Sachs says in the near term it seems like there's more pain, why bother? Why bother at all being in the stock market when you could get yourself a beautiful yield of 3.9% on a 6-month treasury? Why bother being in the stock market when there's just likely more pain ahead? Makes sense. Now, I wanted to show you what real yields are looking like. You can measure real yields through something called the 10-year tips. Don't so much worry about what the heck that is. This isn't a video to go deep on that. But look at this chart right here. On the left, you see this little red dot, which is right here sort of in the middle. That shows you that we last peaked on June 16th, which is roughly the bottom of the market, but it was roughly the top of the tips yields. Well, we have now far exceeded that, and we're expecting a potential new low now because of this. And if you take the previous peaks of the 2000 cycle, the 2007 cycle, and the 2018 cycle, we have now exceeded the tips level of all of those prior cycles. That's pretty scary. That shows some real pain in our markets. Now, what about catalysts? Well, catalysts, folks, you want to write these down because we have 3 more CPI reports coming that could finally show us that inflation is no longer exploding on the levels of shelter inflation, on the levels of inflation that are wage-sensitive sectors like food away from home, or really every single other category that exists that's blowing up right now. We really need to see the numbers come down. So mark your calendar because the following dates are going to be extremely important. Number 1, October 13th for the September 22 report. The October 22 report will be released on November 10th. So you've got October 13th, November 10th, and December 13th. That's when we'll get the November report. In addition to this, we're going to be expecting 2 jobs reports for the rest of the year. We're going to be expecting a JOLTS job openings report. This is going to be an unusually critical report since the Federal Reserve just redefined their priorities as demanding that the jobs report goes down. Jerome Powell literally said, we need the JOLTS report to go down. His word was need, not mine. That's October 4th, very critical. On October 7th, we'll get a jobs report. We'll get quits as well. Keep in mind that quits are different from separations. I saw some comments yesterday where some folks were saying, well, maybe people are just retiring. Retirements are deemed other separations. They're counted separately from quits. Now, maybe you still think the numbers from the government are rigged, and if anything right now, they seem to be rigged in our favor. That means reality is worse than what the reports are actually showing us because the Fed continues to ream us, and I'm a little sore. Another big catalyst will be a GDP update on September 29th, and a gorgeous catalyst in November, folks, the elections. Maybe, just like the 2020 cycle, we will see our bottom before the elections and some peace and quiet for once, please, in markets and politics during a lame duck session of Congress between the end of the elections and the beginning of the new year. Thanks so much for watching. Check out the programs on Building Your Wealth, a link down below. If you're interested in investing in the coming housing crash with me, make sure you go to househack.com. I expect to be able to accept non-accredited investors, hopefully by January. But for now, you have to be accredited. Go to househack.com to learn more about my startup, and you can invest in founder shares. Thanks so much.